Okay, good morning to everybody. So we're going to start today's broadcast. Today is the 9th. It's Thursday. We're going to talk about Chapter 6. We had a lot of technical issues, just tons of technical issues on Tuesday. And I'm not sure that anyone really understands what's going on. We were probably going to move rooms just because of the fact that the interface is not really working. I don't know what it is. I'm an accountant, not a tech person, so a tech person. So I really don't know what's happening, but we're going to sort of mull through it. What I want to talk about here, though, is where we are and where we're going, so that everybody can understand where things are happening here. So we're in chapter week 6, and we're talking about revenue recognition. And I changed the due dates, and I highlighted those on the syllabus. Now, the original syllabus that you see in Brightspace does not have these, and I've sort of moved these back, and it's sort of my practice. Sort of my long-range practice that sort of gives students more time to do work as opposed to less. So sort of for the due dates. So for week 6 here, there's nothing really due this weekend at all. And I kind of like to give people a bit of a break after an exam and whatnot and studying for that exam. So the quiz is going to be 10/17, which is a week from this Friday or a week from tomorrow, I guess. And the homework and bonus, if you want to do the bonus, on that Sunday, which follows that. So I'll adjust these. Now, I have not yet adjusted these in Brightspace or Connect, and I will. If you want to work ahead, there's no problem. They're available to you. The due dates are going to be, not really adjusted, but there's no problem because you're working ahead. But think about this idea that those are available to you if you want to work ahead. But I sort of discourage people from doing that just because there's a lot to do in this course. But if you want to do it, then that's particularly fine to do. So what I'm going to do, we lost a day on Tuesday, and I've really yet to figure out what's going on. Frankly, I feel really silly because I've been doing this for a really long time, and the technical issues we're having in this room are just beyond anything I've ever experienced before. And every time that we call our tech guys to come in, it's something different. And so it's like, my gosh. And so we're probably going to move rooms, which means that I'm going to make an announcement. For those of you who want to show up in person, very few do, but if you want to do it, we'll make that available to you, and we'll explain. It's probably going to be the same building, but it doesn't really matter. But the idea is that we're a bit delayed on what we're doing with regard to Chapter 6. So I'm going to record everything up to what we need to do today and also tomorrow, and probably over the weekend. Frankly, I'll record some videos. I don't know what's going on, and I feel really stupid saying I don't know what's going on, but I'm not a tech person, and so we will try to resolve these issues. But the bottom line is I'm here to work with you. I'm here to get you through these important chapters, and Chapter 6 is a biggie. Revenue recognition, in my mind, is one of the key fundamental chapters in this particular course. And it's the idea of how do we recognize revenue. So it's one thing if we have a small business or whatever, and we sell, something to somebody, they pay us cash, and we simply record it as a revenue and cash in. So we have a debit cash, credit revenue, and whatnot. And so that's pretty easy peasy, right? But particularly in a cash basis system, it gets a little more complicated in an accrual system. But the idea is it's not just that. It's not just the idea of how we record the transactions, how we record them over time. And particularly those events that create revenue and how we record them and how we recognize them. And that's really what's going on here, is the idea that we're really trying to understand how we record revenue over time periods, which maybe they're not long time periods, but they're time periods nonetheless. And so we need to understand what's really going on there. So Chapter 6, which is really what we're into here, deals with revenue recognition. So let's talk about revenues and what they are. As a definition of revenues, this is a pretty textbook definition, obviously. Well, it's the college course, yeah, textbook definitions, right? So revenues are inflows or other enhancements of assets or settlements of liabilities. And I've said before that settlements of liabilities is probably a minority of events that create revenues, but there are occasions in which you sell me this thing and I'll pay off your liability, or I'll assume the liability, or whatever. It's probably not it's probably a small minority of instances, but we have to include it here because it really is definitional as to what's going on with revenues. And it's primarily an inflow, and I think the key word is inflows. And it's inflows from doing the regular business of the regular activity of the business. So if I win a lawsuit and we collect money from that lawsuit, that's really not a revenue because that's really not what we're doing as an ongoing activity. It's not an operational activity at all. So we're not going to really include that. Okay. So that's really what revenue is. And so when we talk about this, and the issue is revenue recognition, and it seems like it should be obvious and whatnot, and students get into this and they think, wow, it's not really as obvious as what we might have considered, because there are a lot of different instances in which different arrangements are made in the business world between buyer and seller and maybe different parties to the transaction. Keep in mind that not every transaction involves one buyer and one seller. There can be multiple sellers, multiple buyers as well. So it's a little bit more dicey in order to sort of divide up what the revenues are and to record them accurately. Because remember, we get back to this overarching goal, and that is presentation of the facts as we know them so that external users can make good decisions. So it's really what we're talking about is how much and also when. Now, one thing I'll say about this is the when. How much is obviously clearly a critical issue. I don't think that is controversial, but the when is almost as important as the how much, because it's when do we recognize the revenue, because a lot of the revenues earned over long periods of time because there are complicated projects that are being delivered to customers, and so how do we fully account for these in a timely manner under the GAAP accounting standards? And so that's really what's going on with revenue recognition. So let's get into it. Let's talk about what's going on here with regard to revenue. And so when we talk about prior GAAP, and there have been some revisions to GAAP, and I don't want to spend a lot of time on this because it's really not that critical to what we're doing, but the realization principle requires that revenue is recognized when the earnings process is virtually complete. For many, many years, and a lot of the years I've been teaching, we said that when the process is substantially complete, we sort of book the thing as revenue, right? The problem is that revenue recognition doesn't really tie into the conceptual framework. Now, the conceptual framework is more theoretical. It's a little bit beyond what we're really trying to do here, but it's the idea of how do we tie in revenue recognition to this whole idea of what the FASB is trying to do with creating the conceptual framework. Remember, the conceptual framework is this idea of how do we know what we know and how do we view these things? And so it's this idea of how do we recognize these certain things? And so, and the focus on the earnings process led to similar transactions. And one of the things that FASB has sort of moved its way onto is more of an emphasis on the balance sheet than the income statement. And for those of us who've been around for a while, there's been a long running debate about which is the most important statements. The four statements that are prepared for users, that is balance sheet, income statement, cash flow statement of retained earnings, and the two that are at the very top of balance sheet, income statement. And which of these is the most important? Well, that's a debate, but most would say that balance sheet is the most important. This is a debate that could go on forever and ever, but nonetheless, the idea is that we want to sort of emphasize the importance of these issues in terms of what is the effect on shareholders' equity, which is really what is ultimately at stake in the balance sheet. Yes, we have creditors' equity on the right side of the balance sheet, but also what are shareholders' interests? And so revenue recognition is a big issue. By the way, your text talks a lot about that in the early 2000s, we had a lot of accounting scandals, and many of them revolved around revenue recognition. Certainly, Enron was probably the biggest offender, and there are books that have been written about what happened at Enron and how they're, creating revenue that may or may not be actual and whatnot. So the regulators have really clamped down on this particular principle, and it's made accountants sort of wary for good reason. And it's a really strange situation that goes back to the early 2000s, culminating in the 2002 Sarbanes-Oxley Act, where a lot of revenue recognition was simply not realistic. And Enron is sort of the most predominant example, but it's not the only one at all. So regulators are really looking at it. And by the way, your text talks about this, the idea that the FASB, which is our regulator, our accounting regulator in this country, has been coordinating with the IASB in Europe to sort of coordinate the terms by which we recognize revenue. We're not quite there yet, and we have standards a little more strict here than there, but again, it sort of reflects this idea of an ongoing attempt to engage in convergence. Okay, so we talk about revenue recognition. There are new standards that in the ASU. Now remember, ASUs are these things are issued by FASB, and they come out periodically. And so accountants usually look for these, and when they come up, they read them and decide whether or not they're relevant to them. But in this case, this is the standard from 2014, and it provides a unified approach that ticks up about 200 pieces of specialized guidance. I don't want to spend a great deal of time on this, but the idea is, how do we sort of replace all these individual industry-specific guidelines for how we recognize revenue, how we can consolidate those into one particular standard, okay? And the core principle here is the idea that companies recognize recognize revenue for goods or services, and let's not forget services because they're a critical part of the economy, when customers are expected to receive in exchange these particular issues, okay? And we're getting into the idea of transfer of title and ownership of the good and whatnot, and some of it verges on services, some of it gets into to goods itself, and so it's a little bit abstract, but I want you to bear with me here because this is really an important issue, and Chapter 6 revenue recognition is really one of the most critical pieces of this. And so when we talk about revenue recognition, what are we talking about here? There are 5 steps in general, and these are generic steps. One, identify the contract. We'll talk a bit about contract here. I'm not an attorney, but if you take a business law, hopefully you've discovered what the elements of a contract are. Two offers and agreement and consideration, all that. But the contractual issue here is, what are the terms of the contract, and do we both agree to it? If we agree to it, hopefully it's in writing. If it's not in writing, well, it's a little bit more problematic, even though the law says that an agreement between two parties that are verbal are binding. Well, that's true. Yes, it's true. It's also problematic. And so we'll get to that. And so we'll talk about the performance obligation. That is what's to be done. This is primarily on the seller's side of things. That is, what is the seller intending to do, and over what time period, and what is expected of the seller, and what the price of it is, determine the transaction price, and allocate the transaction price. Now, it looks like 3 and 4 may be the same, but they're not, because there could be a time element here. And how do we, as the accountants for sellers, allocate these prices, which translate to revenues? Remember, revenues are simply price of the good times whatever quantity is being provided, but it may not happen within the same accounting period, which means we have to allocate it over time. And we have different methods of doing that. We're going to get to that and talk about what those are, those methods. And then finally, recognize revenue when each performance obligation is satisfied. And that's really sort of the capstone to what we're doing here, is the idea of how we finally recognize revenue when it's earned, not when the cash is received. Remember, in accrual-based accounting, what we're really talking about is the idea that we're earning revenue over time, and the cash sort of flows later. And so, it's got a lot to do with the idea we want to match revenues with expenses, and we're going to sort of get to this idea a bit later here, the idea that we want to make this a realistic representation of what's going on. So your text has this. I won't spend a lot of time on it because I just talked about it. The one thing I do want to focus on here is that we have multiple performance obligations. This is really something that sort of throws a wrench into the whole idea here. It's one thing for you to say, okay, change my oil, I'll pay you whatever, $40 or whatever. And that's, I have one transaction, I have one buyer, one seller, and one transaction is done, and it's over, right? But what about if we have multiple transactions and multiple, and I won't even get into multiple sellers that are involved in the same transaction, which is a whole different issue altogether. But rather, the same buyer with multiple sellers, where multiple sellers are involved in the transaction itself. it becomes a little bit more tricky, and because what we're trying to do is to assign the revenue to the individual cells themselves. And so that's a little bit more of a tricky concept. And so in the example in the text, when we talked about the Verizon example, it's a really good illustration of multiple performance obligations. So you have others, but it's not the only one. I mean, you have the Verizon example where you have what is an upfront cost for the cell phone, and you have an ongoing cost of the service. So that's a multiple service obligation. Pretty obvious. Most of us have cell phones. Most of us understand that's what's going on, and frankly, most of us may be unaware that we're paying two different revenue streams, expense streams to us, which become revenue streams to the seller. That may not be obvious. And that's the idea of paying for the phone itself and then paying for the service that goes forward from that. So there are all kinds of examples of this. So what are some other examples? Well, one that may ring true to a lot of you is college expenses, where tuition, books, housing, meals, and parking and whatnot. So there are a lot of examples which kind of bring it back to where a lot of students are impacted. Financial advisory services, we put upfront cost plus any kind of percentage fee over time. That's sort of the world that I just came from before I went back to academia, where we charge an upfront fee and we also charge a performance obligation over time. So that's a mixed cost to the buyer, but a multiple revenue stream to the seller. And we have to understand that there are multiple ways of looking at this from both buyer and seller standpoint. We're primarily looking here at the seller standpoint. Also things like hotels, right? You book a hotel, you pay a fixed fee for the room. Let's exclude taxes here, but you also do things like room service, right? The minibar, whatever. There are all kinds of things which sort of tie into the idea that there are additional services are being provided, and they have different revenue streams, and the revenue streams are calculated differently, and they're tracked differently, and so that's what we sort of need to know about. But it also does not include multiple parties involved, and I talked about this idea that there'd be multiple sellers, and let's think about this, and we're going to sort of get to this a bit later. Home Depot sells you a dishwasher or whatever, right? Let's go with dishwasher. That's one performance obligation, right? Home Depot is the seller, you're the buyer, right? Buyer, seller, it seems like an easy transaction. Either you pay for it up front, put it on your Visa card, whatever, it's done, right? Except now it's not done because they're offering a warranty, which is typically provided by a third party, which has its own revenue recognition schedule. So a lot of people buy things like appliances and also buy the extended warranty. The extended warranty, usually, I don't know, I really honestly don't know what Home Depot's setup is, but they often involve some other party which is involved in it, and they take your premium and they guarantee it. So if your dishwasher breaks down in 8 months or whatever, 4 months short of the warranty period, they send somebody out to fix it. So there are multiple parties are involved. But I say this only because I want to sort of simplify the transaction, right? And say that let's keep it as simple as we can and talk about these steps. What is the contract? Which, and some of these are very, very simple. They go quickly, right? What is in other words, what's the price? What are we doing, right? What is the obligation? Quickly. The transaction price is all that, right? And then how we allocate it is more on the part of accountants internally to decide how we allocate this, particularly from the standpoint of the seller. Remember, we're talking about receiving revenue. Well, the only parties in the economy who receive revenues are those who are providing goods or services. And so as a result, revenue recipients are sellers. And so how do we allocate that? And this is a lot of what we're going to be doing in Chapter 6. And then as performance is satisfied. And it's really the schedule of how we do this. And when we think about these multiple obligations over time, we're going to sort of simplify this and talk about the idea of the time frame. As I mentioned at the outset, the when may be more critical here than the what. And the what is the dollar figure, right? And most of us can easily get our arms around the dollar figure. I pay you to do this and whatnot, but it's over what time period? And so this is something we've, as accounting professors, we've long tried to emphasize to students is flip the script. You're not a buyer, you're not a consumer, you're a seller. This is business school. And so what are we doing in business school? We're training people to manage businesses. So we're looking at from the other side of the transaction. We're providing a service to you, a good service to you. And so you need to pay us this amount. And this is what we're sort of recognizing. But it's not always cut and dry, because there's a lot of issues that complicate this. And a lot of them have to do with timing, as well as what the particular nature of the transaction itself is. And so some of the principles of recognition, revenue recognition, which of the following is not a step used to apply the core principle: transaction or determine transaction price, identify performance obligations, identify the contract, ensure that the price is fixed and terminal. All right, that's clearly the wrong answer, because one of the things about this is, and if you've been reading the text, is the idea sometimes the price is not fixed and terminal, because sometimes we don't know what we're into until we get into it. And I know that a lot of times people want this idea of saying, tell me right now what it's going to cost. And sometimes we don't really know what it's going to cost. In healthcare, this is gigantic. We don't really know what it's going to cost to treat this particular thing you've got, right? And so as a result, it's really, really, really difficult to arrive on a fixed price, because we just don't really know. And even beyond the more critical aspects of healthcare, where it's something like, I think my dad had hired contractors to deal with some termites and whatnot, and they said, "Well, we'll give you a price, but we can't, don't hold us to it." It's like, and he was saying, "What do you mean don't hold you to it? Because we don't know exactly what we're into." So so that's really not an element of revenue recognition. The idea that we lock in a price, because we really don't know until we get into it. And there are lots of areas in the economy in which people do not, sellers, that is, whatever it is, professionals, non-professionals, whatever, don't lock themselves into the price, because they really don't know what's going on until they get into it. And the idea of everyone would like a fixed price and would like a fixed price up front, but it just really doesn't happen. So as a result, it's really not something that we want to hang our hats on in terms of a fixed amount. So, all right, so revenue recognition, in this case, the answer does not apply to D, ensuring the sales price is fixed and determinable, because we really don't know. And that's really, now by the way, why are we focusing on this early on? It's because of the idea that things change over time. And one of the key themes of revenue recognition is the idea that some revenues are earned over very long time periods, and things change, particularly when input costs are changing for sellers. Labor costs, materials costs, whatever the case might be. And so sellers want to leave themselves some flexibility. And the longer the contract period, the more the risk involves on the buyer's part, because they really don't know what they're getting into. And if they can find a seller who will lock in a price, well, good for them. But it's not always the case in point. All right, so we're going to talk about different scenarios that involve how we recognize revenue. The most basic is this: at a point in time where I sell you a good, you pay for it now, it's done. Boom, transaction dead, right? And it is, and whether you pay me today or whether you pay me in 30 days or whatever, doesn't really make any difference. The transaction is done. It's very quick. And there's an obligation to pay the seller, right? So even if I have a men's suit store, right? And there's a men's suit store right down the block where I used to live. They sold lots of suits, and people would come in, buy a suit, and they would pay in 30 days. They get a little invoice in the mail, and they pay it, right? And that's an obligation to pay. They recognize revenue right up front, right? Also, does the buyer have legal title of the asset? If it's a physical asset or not, and we're going to get to this a bit later, do they have ownership of this? And if they get it that day, then yes, they have legal title to it, right? It's theirs. If somebody steals it from them, then that person who steals it is obligated to face the charges, right? If they steal the men's suit or whatever it is. Physical possession, again, that's kind of what we talked about. And also the risk of ownership. So if it's a bigger item, and we're talking about garments, we're not insuring this, but if it's something bigger like a vehicle or a piece of equipment or whatnot, does that party who's acquiring the asset also accept the risks and rewards? And whether they insure it or not is really irrelevant. But is the onus, the onus or the burden on them at that point, and then did they accept the asset? So, and one of the things we're going to get to here in a minute, and it's something that is, I think, problematic to a lot of people, is the idea that this looks like it's completely centered around the transfer of goods, whatever the goods are, right? Physical goods, as inventoriable goods that move from one party, a buyer, to from one party, a seller, to a buyer. But it's also the case with services as well. And so it becomes a little bit more abstract when we say, okay, I have transferred legal title of this to you as a service. I think it's really problematic, and a lot of people, have difficulty with that. And we'll talk about that. And so services are a little bit different. And by the way, when we talk about the goods versus services, we say goods are those physical goods are inventoriable. They can be put on the truck and moved around or burned up in a fire and whatever. And services, none of that can apply. It's usually produced and consumed at the same time, non-inventoriable in nature. They're, you can't put them on a shelf or a shoplift a service and whatnot. So what we're really trying to emphasize is the fact that the economy has really different elements of transactions. But when it comes to revenue recognition, there's a desire to achieve some sort of convergence between selling of goods and selling of services. So the big issue, it's been going on for a very long time, and I can't tell you that we've gotten to the promised land here in terms of this, but we're sort of working on it. So, all right, so here's an example. This is an example that goes on throughout chapter 6. And by the way, this is Thursday, 11:10. I'm going to be doing much more recording in the next couple of days, just because of the fact that we've had some delays, and I'm going to probably move rooms because I'm not convinced that anybody knows what's going on here. I'm an accountant, not a tech person. So I will. So look for those videos under the module for chapter 6 in Brightspace. I'll post them there just as soon as I can record them. I promise you I will do that. I just can't get access to these rooms. They're not like available 24/7. Well, unless I stay here all night. But anyway, I'll put them available as soon as I can. So, all right. So, tech industry or true tech industries. This is an example that we're going to sort of cover here over the next few segments here in this chapter. They sell a Tribox, which I guess is some sort of gaming console, and it allows users to play video games. And so the question is, when should true tech recognize revenue from the volume sale of 1,000 Triboxes? Comp stores. So comp stores, so this is a manufacturer. So True Tech Industries is a manufacturer, right? And comp stores is a retailer. So let's kind of be aware of what the relationships are here. And there's no wholesaler involved. And of course, wholesalers are kind of disappearing in the economy. So this is a manufacturer. They make Triboxes or Xboxes, I think is what they're trying to get to. And then this is the retailer. And so when should we recognize it? So let's talk about the events, and let's track the events to when the recording should happen. So December 20th of 2020, comp stores ordered 1,000 Triboxes at a price of $240 each, promising payment within 30 days. There is no entry. Why is there no entry? Because there's no event. There's nothing to record. Now remember, this goes back to principles 1, in which we talked about the idea that if all we're doing is quoting an order or making an order, and there's nothing that's really happening on this, then there's no transaction involved here. All we've done is make an order, right? And there's nothing that's really been happening, so there's no entry, right? So there's no entry in this particular transaction, so we have to kind of be aware of that. So, and no asset's been transferred, no control has been transferred. All these, and remember, we go back here, one slide here, one of the elements of a transfer of property, which relates to a change in a transaction that creates a revenue on one side and expense on the other side, is this idea of a change in title. There's been no change in title. All we've done is say, hey, we order whatever the number of Xboxes were, not Xboxes, whatever this box were. So there's no change here. Tribox. So there's been no change in transfer of title, so as a result, there is no transaction. Okay, there will be a transaction. We assume. I mean, nobody would order 1,000 these units unless they really plan to sell them. So on January the 1st, I know that This is one of the crazier things about accounting textbooks is the idea that we have things due on January 1st and December 31st, which is really crazy. But nonetheless, let's kind of go with it here. So on January 1st, TrueTech delivers 1,000 try boxes to comp stores. In other words, TrueTech, the seller, comp stores, the buyer, and title transfers to the comp stores. Now let's get away from the idea of freight in, freight out. Let's not worry about that here. That is a real life consideration, particularly with physical goods, as to who pays the freight. And freight in costs are usually borne by the buyer. But let's ignore that here because what we're really trying to isolate here is revenue recognition. On the part of not the buyer, on the part of the seller. The seller is who incurs or experiences revenue. So that's really what we're talking about here. So I bring it up only because, yes, in the real life, there'll be this idea of who pays the freight. It's missing here. So 1,000 try boxes to comp stores on January 1st. And so as a result, the sales revenue is a credit, and we have the debit offsetting the accounts receivable, right? So they haven't been paid yet, but they will be paid. So it's January 1st, okay? That's the first series of these transactions that deal with this particular event, okay? So on January 25th, they pay the receivable. Or they pay, well, from their standpoint, the payable, that is the comp stores pays their payable 240, which is a 240 receivable from on the part of TrueTech. And so as a result, we debit cash and credit accounts receivable, right? And that wipes it out. So if you go back, remember, we're going to zero out this account receivable because on January 1st, we created an account receivable, which is a debit balance. We're going to wipe that out with the credit balance once we receive the cash. And so cash goes up. So again, think about these transactions in terms of debits and credits and the idea of what these, how these affect the overall chart of accounts, okay, or the general ledger, say. Okay, so that's January 25th. All right, so, and we'll come back to TrueTech. It kind of comes back again and again throughout this course. And so, quick quiz here, a little intermediate quiz. This is which of the following is not a key indicator used in deciding whether control is passed from seller to buyer? Number one, seller can identify contract with the buyer. B, buyer has an obligation to pay the seller. C, buyer's legal title. D, buyer has physical possession of the asset. Okay, well, this is one that's a little tricky, actually. I had to kind of look at this in a lot of ways in order to get the right answer. But the right answer is going to be A, seller can identify the contract of the buyer because the buyer is more likely to control this good or service. And so as a result, they should know what's going on here, right? So, and the other ones are stronger. This is not the greatest quiz question I've ever received, having written a lot of quiz questions, but there is no question that B, C, and D are absolutely correct. Buyer's got an obligation to pay the seller. I mean, we can't be accountants without emphasizing this obligation. Buyer's got legal title of the asset once it transfers, and then buyer's physical possession of the asset. And again, whether it's a good or service, and I know we tend to think of this as being more goods related, physical goods related when we talk about physical possession, but it is sort of a metaphor for services themselves. And we'll get into that a little bit here. And it's not something we're going to emphasize a lot in this course, but it's something that, because of the fact that services have grown so much more in terms of prominence and overall gross domestic product, I think we need to understand that services are really an important issue. And by the way, U.S. exports a lot more services than imports. So we have a huge balance of payments surplus in terms of services as opposed to what we import from other countries. And so, and it's a positive. It's a sort of it's a plus to our economy and whatnot. So, I know sometimes, particularly counting 2110 and 2120 as principles 1 and principles 2, we sort of focus on manufacturing, which a lot of people we debated among ourselves as to whether we should sort of focus on that. But the idea is that services are definitely growing much more quickly, and it really is an important area of the economy. And I would suspect it's going to be way more important than physical goods as we go forward, particularly with technology, which tends to divorce ourselves from physical goods. So, all right, so that's that. So, any questions? I don't have many people we have on the live Zoom here, but any questions at all? All right, another quick quiz here is key indicators of transfer of control. Which of the following is not an indicator in the control of goods past? Buyer's legal title, buyer's unconditional obligation to pay, Buyer's schedule delivery, buyers assume the risk. Okay, well, it's going to be B here, right? Or, I'm sorry, it's going to be C, and that's schedule delivery, and that's the idea that I'm sorry, I meant C. It's the idea that we don't know when the schedule delivery is going to be. It doesn't really matter that much because remember, in accrual accounting, it really doesn't make any difference when when goods are received or even when goods are paid for. It's more about the idea of when things are established, when the contractual obligation is met. And I'm not an attorney. I do not teach business law, and so this sort of intersects with that a lot. But the idea of having legal title means the transaction is complete, as well as the buyer has an obligation, right? And also the risks and rewards of ownership. And by the way, sometimes when we talk about risks and rewards of ownership, it is often the case, particularly when it comes to inventory, where buyers of goods can resell those goods, like Walmart, Home Depot, whatever, and they can resell them and earn a profit and earn the cash flow resulting from it before their invoice is even due. So that's if that's not a reward of ownership, I don't know what is. So Home Depot gets whatever they can't paint, and they sell it before they're obligated to pay for it and whatnot. And so that's a pretty good gig, right? So, but the issue is here. What is the issue of control? And that's really what's going on here. So, all right. So that's the first element of revenue recognition. This is the most basic, right? But it gets a little more complicated. This is what we're going to delve into, and this is why Chapter 6 is a really complex chapter. It's not. I don't think it's overly difficult, but it does take some time to study. There's no other substitute for time spent examining these issues when it comes to intermediate accounting. I just don't think it is. I mean, I remember my days studying intermediate accounting. It was frustrating, and but if you really love the accounting profession as I do, it's worthwhile because it really immerses you in what's going on. And it's really the critical piece, as I mentioned on day one, it's a critical linkage between college coursework and the profession itself. And I'm talking about the CPA profession primarily. So, all right, so let's talk about, so we talked about one revenue recognition event, which was when it happens at a point in time it's done, right? And I buy something from you, I pay for it. Even if I don't pay for it 30 days, 60 days, whatever, it's still sort of the same event, right? Even if it's a consumer to, a B2C transaction where I buy a suit from you, I pay in 30 days. I don't know how common these transactions are these days. Or more commonly, I buy inventory from you and I pay you in 30 days or 60 days or whatever the case might be. But those are still sort of a point in time. Those are fairly linked in time, and it's simply one transaction, whether it's receivable or payable on either side of the transaction is mostly irrelevant. And in business transactions, we often have the idea of trade credit, which gives buyers the time, because usually we ship goods. Truckers usually aren't equipped to accept checks, so they can. I've seen it happen before, actually, but it's not common. So but it's a very common set of events throughout the economy. However, we want to get into some other scenarios where we're talking about recognizing revenue over a period of time. Remember, we're talking about sellers recognizing revenue. Buyers do not recognize revenue. It's not a buyer concept, it's a seller concept. So recognizing over a period of time means any of the following. I highlight the customer consumes the benefit of the work that's being done, or the customer controls the asset as it's created. And by the way, we sort of expanded the definition of asset to include the value of some service as well, right? And it sort of defies the originalist definition of asset. Or the seller is creating an asset that has no alternative use. And so therefore, the seller is selling you a good that's only applicable to the particular buyer. And it's really interesting, and we've talked about this a lot, and particularly in this part of the country where there's lots of defense work going on, where there is no other use for the particular good. I sell you an Apache helicopter. There's nobody in the world. I mean, IBM is not going to buy an Apache helicopter. Microsoft is not going to buy a Black Hawk helicopter. I don't think, right? So maybe I'm wrong about that. But the idea is that there's an asset that's got no alternative use. This is the buyer and the seller, and so as a result, I'm creating this for you, right? and I don't want to even get into the whole issue of the legal, the national security issues. The point I want to make is the idea it's a unique asset. So revenue is recognized under these criteria, and any of these are applicable, particularly over long time periods. Now, what is the logical? What am I saying here? I'm saying there's a period of time going on where the good in question is being produced over a long time period, and it's usually not helicopters. It's usually big projects, often related to construction, and that's really what's going on. And by the way, construction is an area that is almost the exemplar of an industry that we talk about with revenue recognition, because it takes a while to build these assets. And the question is, who owns the assets, and how do we recognize revenue as it's being generated over time? Because it could create a long time. And you might think, well, construction, okay, I build a house in 60 days. We're not, yeah, houses, yeah, it's one thing. What about a hotel in Las Vegas, where it takes 3 years to create, right? What about a submarine that takes 4 years, right? Or an aircraft carrier that takes 5 years. I have no idea whether these are accurate numbers at all, but I do know these are longer term assets. And as a result, how does the seller create revenue? And by the way, we're trying to communicate to external users what the earning of revenue is. And by the way, we expect to be paid. We're a seller. We expect to be paid for them. And this is one of the areas in which there's sort of a convergence between IASB and RFASB in this regard, even though there's a bit of a difference here. But the idea is, if we reasonably expect to be paid for it, then we can call it revenue. Now, if we can't reasonably expect to be paid for it, then there's another issue, and we're not going to get into that. That's a whole other can of worms that we won't get into here. Okay. All right. So we have a T account here. All right. So TrueTech, this is the company that makes Xboxes, or they're not really Xboxes, they're whatever they are, right? What they're called. And they have 1 year subscription to TriNet multiplier platform of internet-based games. So they sell thousands of subscriptions for $60 each. So as a result, well, the math is simple. 1,000 times 60 is going to be cash up front, and we're going to debit cash, we're going to credit deferred revenue. Now, why do we credit deferred revenue? Because we haven't earned it yet. Why haven't we earned it yet? Because it's a 12-month subscription. As we provide this service, we're going to sort of, and usually on a monthly basis, and a lot of accountants do monthly adjustments where, okay, 1/12 of this is going to be, well, 5,000. The math is easy. And we're going to sort of adjust this as we earn it. Yes, there'll be cancellations and all this sort of thing, but let's not really confuse the issue here by saying that there are going to be those kind of things going on. What we're saying is that this revenue is going to be earned over time, right? That's really what we're trying to get at here, is the idea that we sell these subscriptions and we're going to be earning this amount over time, right? We collect the cash up front. And by the way, it's deferred revenue. So remember, deferrals, and when we talk about deferrals, we're talking, one of the key areas of deferrals is unearned revenue. Deferred revenue is the same as unearned revenue. We collect the money up front and we have to provide the service, right? If we don't provide the service, that's another issue, but we're assuming we're going to provide it. And we're going to decrease this as we increase sales revenue. Revenue, a sales figure, which is a credit balance account, has not yet been credited yet, right? And we may be doing an end zone dance and spiking the ball, having sold thousands of subscriptions, but we haven't earned any revenue yet, right? And so we have to make sure that we collect the revenue over time. And cancellations are another issue we'll get to a bit later. So, all right, so here we go with regard to the revenue over the 12-month period. So remember, we booked 60,000 in revenue for the 12-month period. 60,000 divided by 12 is 5,000. So we're assuming there's no cancellations and we're going to do debit deferred revenue and book it over to revenue, right? We're going to move it over from here to here. So that's the result. So we will have earned the revenue by providing that subscription, right? We will have earned the revenue. So, and we go on from month after month after month. We have earned the revenue going on, right? And again, without getting into the idea of cancellations and whatnot, and that's something we get into a bit later in this segment, but the idea is we've earned revenue. The key thing is we want to focus on the journal entries when we book a credit balance for deferred revenue, which is a deferral, right? So liability. Remember, liabilities are credit balance accounts. Why is it a liability? What does it represent to the seller? It represents obligation. We have something we have to do to provide going forward, right? And we're going to provide the service available, right? But as we earn it, we debit that, we reverse that credit balance, and how we debit the balance, or how we balance I'm sorry, how we balance the debit as we credit revenue here. And as we go on, that's essentially what's going on. This is really the heart of accrual accounting. But what we're really trying to explain here is the idea that sometimes revenues earned over a very long time period. And we see lots of these. The Verizon example, I think, is a good one. It's not the only one at all. Comcast, AT&T, whatever, a lot of times have long-term obligations where they're trying to provide goods over time. And so revenue recognition is really an important issue here. And in most cases, it's really not all that complicated, but it becomes a little bit more tricky when we talk about this idea of earning revenue over long time periods. Okay, so that's what's going on with this particular event, and we're going to come back to the TrueTech example here as we get going. Okay, all right. Any questions about that series of transactions? Okay, now what happens when these three criteria do not apply? All right, well, what three criteria, right? These criteria, right? Where the consumer consumes the benefit, or I'm sorry, the customer consumes, whether it's a business or government or whatever, whoever the buyer is, if they don't consume the benefit, if they don't control the asset, and there's no alternative use for the asset, then what do we do? All right, so let's talk about what we do in this case. We recognize revenue at the point in time when which we decide that the performance obligation has been completely satisfied. Now, this is a bit of a stronger language than what a little bit, I shouldn't say strongly, a bit of a modification of where we said substantially completed. And it's the idea that when we decide that the work has substantially been done, then we can sort of say, all right, it's done. We recognize revenue, whatever the case might be. And again, I think we come back a lot to construction because and all the building trades, we're talking about big projects and they cross accounting periods. And that's really what we're doing here is we're crossing accounting periods and we're deciding, hey, how much revenue has been earned and how much expense has been incurred and what is the fair way to represent this? So I think that's really what's going on here. So it's not always the case with these three criteria. Do not always sort of fit the bill here. Okay, and then we're talking about progress toward completion. This is really the big one here, and this is, I think, when we talk about revenue recognition and why I said at the outset, it's really a very critical piece of intermediate accounting, is because there's so many transactions, so many economic events where accounts are involved in trying to understand what's going on. And one of the big ones here is this progress toward completion. And we have a lot of different methods by which we account for this, and we use what we call the percentage of completion method. But before we get to that, we'll talk about this idea. There are two different ways we can look at it. One is output-based estimate, where we're looking at the value of the output, and we assess where we are in terms of completion of the output-based value, whatever it is, right? How many square footage that we've created, or whatever, what is the percentage of the building that we've created. And again, I come back to construction because it just sort of it fits this goal almost perfectly. But there are also input-based measures, which personally I think is a little bit more in line with what we want to do as accountants, particularly since we're incurring costs here and we're trying to measure those up with the revenues. And that's the idea of the proportion of effort. Effort is a sort of a code word for cost, right? Effort is the idea that we're spending our resources and incurring costs, and because we're expending them, we're in the language of accountants, we're incurring those costs, and that's really what's going on. So the word effort, and by the way, this is something that's kind of come up in accounting textbooks, which I didn't see, a long time ago, but I kind of like it. I like the idea of effort, and it's the idea of expenditure. It's this idea of what we're doing, what we're putting into it. We're the seller. Remember, we are the seller here. Business schools tend to focus on sellers' point of view more than buyer's point of view. Economics, maybe it's a little bit different, but in business schools, we tend to focus on sellers because businesses are sellers of goods. And so we're talking about what is the effort that's been expended on this. And so output-based may be an example. Just to give you an example here. Painting contractor, we have to paint, I don't know, a surface area 20,000 square feet. And we're crossing an account period. We've only done 8,000 square feet. So that's, what is that, 40%? And so as a result, all of our costs are going to be based on that particular measure. It's an output-based measure. And the input-based measure is what is it going to cost us to do whatever it is we're doing? And it's not based upon some outside estimate between buyer and seller. It's based on our own estimates. It's going to cost us $300,000 to do this particular job. We've expended $150,000. So as a result, as we cross this accounting period, 50% of the total costs are going to be incurred, and we're going to expense them as we go. Now, this is, and by the way, we're also going to bring the revenue forward, right? Now, remember, this is revenue recognition, right? So we're going to bring the revenue forward as well as we bring the expense in. So the revenues and expenses cannot be divorced from one another. And so the key issue is what proportion do we recognize as we go? That's really the important factor here. How much do we recognize as we go? If it's a very short-term deal, I sell you a Twinkie, no big deal. Nobody worries about that, right? I go buy a cup of coffee at Starbucks. That's not, revenue recognition is simple, right? But I build an aircraft carrier. That's a different deal. I'm building a hotel in Las Vegas, or I'm doing whatever. I mean, it's a different sort of thing. So over long time periods, we can choose either method. And I think there's I personally prefer the input-based method, but nonetheless, it's personal preference. And I'll tell you when it's my preference and whatnot. And I'm far from the last word on this, because we are a profession that deals with what we're told to deal with. So as a result, but those are two different methods. I mean, by the way, we have all kinds of alternative methods everywhere in accounting. I mean, you open an argument of one area and you get another going on. So anyway, that's a method toward achieving completion and recognizing revenue. So quick quiz here, what we call concept checks. Recognizing revenue. Which of the following is an indicator that revenue for a service should be recognized over time? A, the seller is enhancing an asset. Well, that's kind of a sort of a textbook example of what a revenue is, okay? B, the seller is providing continuous effort to the customer. C, the seller can estimate the percentage of work completed. D, the sales price is fixed and returnable. Well, it's going to be A, the seller is enhancing an asset, because the fact it's not really tying it. Now, it's a textbook definition, as I mentioned a second ago, but it doesn't really tie into how we recognize revenue, because the fact that, yes, we're enhancing an asset, but it's not necessarily the case the customer controls the asset as it's performed. And we talked about this idea that there's a lag time sometimes. And so this is maybe not one of the strongest quiz questions, but nonetheless, it is sort of there for us to sort of look at and kind of go from there. All right. Okay. Now, and then finally, we'll get to this idea of multiple performance obligations. And we only got about 7 minutes in this particular class session. I do not think we're going to get anywhere near done with this, because this is really fairly complicated. And that is the idea that one seller has multiple obligations to buyers. Okay, it's not just, it could be I'm one buyer, one seller. It could be very simple as that. But the one seller's got multiple obligations. And I do like the Verizon example. It's far from the only example that we've got going on here. It's the idea that sometimes sellers have all kinds of different obligations to sellers. And so we have to understand what's going on. And we have to, furthermore, define when revenue is earned on these, so we can sort of separate these out. And this is where accounting gets a little bit complicated. And it really needs to be sort of explained. So think about this: you go to Jiffy Lube and you get an oil change, and you also get a transmission service. These are two different events whatsoever, right? Okay, two different obligations. And again, it's a business to consumer transaction, but hopefully you get the idea. These are two different things going on. By the way, I can complain about the oil change, have no trouble with the transmission service. These are separated transactions, right? These obligations are different. Maybe they completely messed up my oil change and did grant on the transmission service, or whatever, or vice versa, right? It doesn't make any difference. The idea is they're separable, and so as a result, the obligations are different. And this is not uncommon at all, where sellers have different things they're doing for different buyers. And as a result, they can be separable. And to the extent they're separable, we can allocate the revenue earned from those to these different activities, right? And also, which is sort of a corollary to this, we can absorb the costs that are applicable to those as well, which is what we really want to do in terms of matching, is matching revenue with costs. And so first of all, the steps are identify the contract, which is usually that's not something that's too complicated. Identify what the obligations are. That's what do I expect for you to do? What is the price? And then allocate to each performance obligation. So in this case, the seller's point of view here, how do we allocate these, right? And again, the oil change and transmission service may not be the best example because they're both done at the same time. They may fit the first category here. But nonetheless, the idea is how do we allocate one price of one service the total amount received to one activity versus another activity. And that's something we're going to get to, and that's what revenue recognition seeks to involve. Remember, at the outset, we talked about the idea of the what and the when. The what and the when. How much, right? And then when we receive it, right? And when we record it. And so those are two different obligations that we as sellers need to recognize. And so we're going to talk about as these obligations are satisfied. And by the way, they may not all be satisfied. If we're talking about something that's pretty basic, where it's in and out, we're done, that's great. When it's not, that's a different issue. So, and we're going to sort of open the door here a little bit. We're going to talk much more about this multiple performance obligations because it becomes a really key element of what's going on here. Because a lot of sellers have different obligations to the same buyer. And it's not just one good. And this is the thing that we don't do a service well to our accounting students early on. We say, I'm 7-Eleven, I sell you a Slurpee, and you pay me $2, I give you a Slurpee and whatnot. But sometimes it's more complicated than that, where I have multiple things I'm selling you, right? And they have different means of revenue recognition and also expense absorption, which we're going to get to a bit later as well. But the idea is that how do we separate these activities out? And so when we talk about this, we're almost out of time here, but we have to identify what the obligation is. So they may not be overly complex. We need to decide what's going on. But a good or service is distinct. It is both, this is important, capable of being distinct. And that's important. This is the thing I sort of talked about before. How do we separate these activities, right? And then because they're simply identifiable, we can simply say, all right, we can account for them differently, right? This is really the same thing as the idea of capable of being distinct and separately identifiable. Now, maybe that's not exactly the same thing. I know what the authors are saying. They're saying, can we separate these out? Okay, it's different. I go to get surgery. Can I subtract and factor out anesthesiology from the overall cost of the operation? I don't know. I'm not a healthcare economist or an accountant, but can we separate those out, right? There are things that we really can't separate out because it's too difficult. But if they are capable of being distinct, then we can create a separate identifiability, and therefore we can do the accounting of revenues and then later expenses. But in this particular segment, we're talking expense revenue recognition. And so that's really what's going on there. So can we separate those out? There are a lot of times in which we can't separate this out. And don't even get started on healthcare because it's the accounting for that is, and when I did my doctoral work, we were just delving into all these expense categories, and it was just impossible to sort of pull things out, particularly when it came to things like surgeries and medical procedures and whatnot. But you get the idea that sometimes it's difficult, but if you can do it, then do it, right? And so from the seller standpoint, and I would say probably the majority of cases are the case where we can separate out the activities and therefore create this idea of what we call separately identifiable. And therefore, we can sort of track the activity as it goes from one job to another, the same job all the way down, okay? Not one job to another, but one job all the way down, right? And then, so this is a good place to leave off where we're going to talk about what some of the issues are, particularly with regard to the true tech industries example here, where they're selling these subscriptions where we get multiple lines of business. And this is something we talk a lot about in the business world, is we have different LOBs, lines of business. We have revenue up front. We also have ongoing streams of income, right? And they're different, and they're separate. and we can account for them separately. And that's what we really need to do here, is the idea of break these things out, because they're different lines of business that create different streams of revenue. And we want to make sure that we understand what's going on here, right? If you're an insurance company, you're selling different policies to different people. You have different streams of income coming in, and you want to make sure that you separate those out, okay? All right, so it's 11:44, and so I'm out of time. Again, we are behind the pace, but I'm going to get caught up because I understand that that we need to do it. I will produce more more revenue, revenue on my end. We'll produce more videos so that we get to the end of this. I've deferred the due dates for Chapter 6 activities just because I want you to have more time to study this. I really, really, really think this is the critical piece. This is the linchpin, I think, around a lot of what Intermediate 1 revolves around, because it's tricky, it's not easy, you got to kind of delve into it, and I want to make sure people have more time to do it. So I wanted to sort of defer those due dates. So, all right, so any questions from me, from either on the Zoom or the class? All right, well, have a great weekend. I will record additional videos here, and we will we'll pick this up, and when we come back on Tuesday, I think we'll wrap this up, hopefully, and then we want to move on, just because we've got a lot to do in intermediate, and we'll move on to the next segment after that. Okay, have a great weekend. See you next time.
Thanks, sure.
Sure.